Please be advised of the disclaimers.
Hey everyone, welcome back to my channel. It's Sai with Pinnacle Trading here. We're going to take a look at the bond yield curve today in this video, and I'll explain basically how it works. I'll keep it brief and simple as possible, and we'll go into a little bit of depth on it today. So in my last video I talked about Apple Tesla stock crash, we talked about markets peaking, and now they're selling off a little bit. So we'll jump into that right now. So let's take a look at S&P 500. That's SPY, that's the symbol for that one. And we see markets, slowly starting to sell off as we zoom in here. They peaked at about 394, and now we're testing 380 support. So next, we're going to take a look at the yield curve definition and what it actually is. So in the last one, I looked at the chart and I showed you how this leads to recession. And let's take a look at how it actually breaks down, what it actually is, and I'll show you how you can actually play it in the market, and basically how it's going to show you what to keep away from and what to look for and when to be careful in the markets and just in the economy overall. So what is a yield curve? According to Investopedia, this is a great website that I use for investing terms, definitions, and some tips and tricks here and there. So a yield curve is a line that plots yields, interest rates of bonds having equal credit quality but differing maturity dates. The slope of the yield curve gives an idea of future interest rate change and economic activity. So you can read through this. I'll leave this slide up for a little bit. So basically there's three main types. So we have a normal upward sloping curve, we have an inverted downward sloping curve, and then we have a flat one. So the three of them, the first one's going to be normal. It basically shows you increasing steadily with the length of time until they mature, but flattening a little for the longest terms. This is the normal one. That's why it's a normal yield curve. That's what we see when markets are pretty much bullish, nothing bad going on, economy's growing and everything. So a steep yield curve doesn't flatten out at the end. This suggests a growing economy and possibly higher inflation to come. So we did see this last year in 2020 when we saw the big market correction. We saw the big panic sell-off with COVID fears. The last one's going to be flat yield curve. It shows little difference in yields from the shortest term bonds to the longest term. This indicates uncertainty. This is when we're kind of shaky in the market, 50-50. We don't know if it's going to go up or down. Things are kind of uncertain in the economy itself. This could be when a new president is getting elected, or we have the federal interest rates changing, mortgage rates changing, just things like that in the market. And then we have the rare inverted yield curve. This is usually before a recession. This is what happens like back in 2008 or 2002, 2003. That's where we see signs of trouble ahead. Short-term bonds pay better than long-term bonds. So short-term investments aren't paying that good in the market as a long-term. Inverted, vice versa. We see short-term bonds paying better than long-term bonds. So let's look at this on a chart. So we can see on CNBC, we can just go to cnbc.com, we can click on the bonds tab, and then you can click the 10-year. The 10-year is what most people usually look at for the inverted yield curve to predict a recession, and I'll show you in the chart in just a second. So when we look at all time, we can kind of see how it goes down, and then we see that when we get closer into the 1 year, we see that, kind of flattened out. Let's look at the 5-year. So we see it came down. We can see this back in 2020, how it came down. So look at how this one. So rare inverted yield curve signals trouble ahead. When we see that steep yield curve doesn't flatten out at the end, that suggests a growing economy and possibly higher inflation to come. And then what happened? We did see more inflation come in because they've been printing more money with the feds and everything and pumping it into the market. So when it falls, it indicates a higher inflation to come. And for uncertain times, when it flattens out right over here, that's where we can see that it indicates uncertainty. So we don't know what's going to happen in the economy. People are very uncertain, getting very kind of restricted with their investing, holding onto their cash pile. And then we see the inversion. That's where it starts going up. And that's where we see that the rare inverted yield curve signals trouble ahead. Short-term bonds pay better than long-term bonds. So that's where we see this inverted yield come in, and that's because we see a lot of inflation and the economy isn't as great right now. A lot of unemployment, also a lot of people losing jobs. Unemployment is pretty high, so that's where we see economy kind of take a downturn, and we see the inverted yield curve go up, and we see the stock market also, it peaked. All this week people were talking about the yield curve, and we saw markets peaked and we saw them coming back down. So how does this play into the market itself? Why am I putting this on my stock market channel is because when we see inverted yield curve, where we see break below zero and then starts inverting going up, this is where we see that anytime it went over that 2%, 3%, that's where we saw a recession. So back in 2008, back in 2002, 2003, 1992, about 1985, 1982, and then we also see 1970. So this indicated the past 7 recessions very closely. So past 50, 60, 70 years, it's been predicting the recession very well. I think we'll see one in the upcoming years, maybe this year or next year, maybe closer to the end of this year. I think we can see a huge sell-off in the market and also economy take a downturn. So let's see how that plays out. But that's basically what the 10-year yield spread is. We can also look at the different yields: 1 month, 1 year, 2 year, 10 year, 30 year. We mostly look at the 10-year because that's not too far away, but it's also close enough that we can predict things a little bit better. When we look at 30-year, kind of like a 30-year home mortgage, we don't know what's going to happen in 30 years. It's kind of hard to predict that, but we can predict closer time, but not too close, but also not too far away, which is 10-year. That's why CNBC also highlights that 10-year one as well, and that's what they talk about a lot. So we can also trade bonds itself using Vanguard fund, and that one is going to be right over here. So you can use TLT. This is going to be a 20-year bond, and you can also use another one, SBLB, like this one as well, because it's a long-term bond ETF. And there's many other ones as well. I like the BND one the best, just because Vanguard is one of the best ones. They have low rates to get in, low cost rates for the year, and also you can see how it grows very well from the overall chart. So when we look at the max one, we can see a nice growth in that one overall, and we also see a short dip right now, but we also see a little bit recovering. So these are just different funds. You can play it off the 10-year, 20-year, 30-year. You can also play the overall, kind of like what this one is. The BND is kind of like an average of all of them. So I hope this video helped you out on what an inverted yield curve is. And if you want to get into more charting in depth, you can join the chat room, which is completely free. This is where I posted the link. The website that I use over here, gurufocus.com. It shows a nice simple chart. If you want that link, it's in my chat room in the charts and analysis tab right here. And you can also look at CNBC. It doesn't show you the inverted yield curve, it just shows you that, but it doesn't highlight it with the market itself. So you can also go to CNBC, like I showed you, click on the bonds tab and get into that. If you want to get into more advanced charting, head over to my website, pinnacletrading.us. Link is in the description, and you can join the chat room for free. You can also grab my course where I teach you step by step about trading, investing, stock market education, how to get into the proper mindset, and then some of my secrets to you. So I hope this video helped you out about bonds, yield curves, and recessions and how that relates to the market. And make sure to hit that subscribe button if it helped you, and the like button, and I'll see you in my next video.